I don't want to be a trader. I don't want to wake up every morning asking if I should buy, sell, or panicking because the market or my stocks lost 5% the day before, or in pre-market they are losing 10%. So I don't want to do this. What I want to do is finding companies that can compound for 10 years or more. Companies that can become multi-baggers in the first few years, but then keep compounding after that because the business itself is getting stronger. The key point is this. I don't want to check my portfolio every day. I want to check my thesis, right? Because if the thesis is still on track, volatility is noise. And if the thesis is broken, then the stock price doesn't matter. To say this with Warren Buffett words, what I'm looking for is little snowballs on top of very long hills, where the hills are the markets and the little snowballs are companies, extraordinary companies with extraordinary management that have a moat that is compounding. I start with qualitative analysis looking for durability. So the first filter is durability. I'm not looking for random cheap stocks. I'm looking for businesses where the moat can widen over time. The moat of the next decade is increasingly more data, distribution, and learning loops. Data alone is not a moat. Proprietary data has a lot of meaning today, but if you cannot execute on this data, I don't think you have a moat. Distribution alone is not a moat either. The real moat is when every new customer, every transaction, every claim, every lab test, every lesson, every ID impression, every mile driven makes the product better. More users create more data. More data improves the product, and better product attracts more user, and the loop restarts. That is the type of compounding I want you on. In the I world, AI is not a moat. So AI is a buzzword, it's not a moat. The moat is proprietary data, distribution, workflow ownership, and the ability to convert all of that in a system that learns faster than competitors. To the qualitative screen. So the first real step is qualitative screening. Sometimes the idea starts from X, sometimes from another investor, sometimes from a company I already own and an adjacent thesis I want to understand better. But the question is always the same. Can this business become stronger as it gets bigger? I'm looking for proprietary data, own distribution, a workflow the company can control end to end, a customer relationship that gets deeper over time, a product that improves with usage, a market big enough to support many years of compounding. At this stage, I read the annual report, shareholder letters, feelings, investor presentations, earnings call, and I try to understand the business at first principle level. So not the stock, the business. What does it sell? Why do customers use it? What improves as it scales? Where is the hidden flywheel? If I cannot find a learning loop, I usually stop digging deeper. Few examples. Take Lemonade. More user can mean more claims data. More claims data can mean smarter underwriting. Smarter underwriting can mean better pricing. Better pricing can attract more users. That is a learning loop. Now, take HIMSS. The loop is different, but it's still a loop. Symptoms, labs, treatments, outcome, subscriptions. If HIMSS can connect those pieces at scale, healthcare becomes less like a one-time transaction and more like a data-driven operating system. To Duolingo, they have learning data. Meli has commerce, payments, logistics, credit, ads, and fraud data across Latin America. Zeta has customer intelligence and intent data. Tesla has driving data, fleet behavior, charging, autonomy, energy. The question is the same. Does every user make the system better? If yes, the company may not scale linearly. It may compound. A good story is not enough. A moat that only sounds good in a management presentation is not a moat. So I want to see it in the data. If the company says it has better product, I want to see retention, cohorts, usage, frequency, pricing power, margins, operating leverage, or customer growth. If the company says it has data advantage, I want to know what data it owns, why it is proprietary, how it improves the product, and why competitors cannot replicate it. If the company says it has distribution, I want to see whether acquisition is becoming more efficient or whatever management is buying growth. And I don't want to rely on management, so I look for external verification. Competitors, customer reviews, regulation, market data, independent research, industry experts. The point is not to prove myself right. The point is to find where I could be wrong before the market makes me pay for it. Only after that, I move to valuation. So I don't start with is the stock cheap. I start with is this company good enough to deserve my time? Then I use my 4D valuation framework to understand whether the current price makes sense compared to the opportunity. For the kind of companies I buy, I don't need them to look statistically cheap today. But I also don't want to buy something that is priced for perfection. What has to happen for this investment to work? How big can the market become? What margins can the business reach at maturity? How much dilution or reinvestment is needed? What multiple could the market assign if the thesis is right? And what is the downside if I'm wrong? A great business can still be a bad investment at the wrong price. So the position has to matter. This is about portfolio construction, and this is where many investors fool themselves. So if I buy 100 stocks, sooner or later I will own a multi-bagger, right? But if it was 0.5% of my portfolio, who cares? The point is not to own a multi-bagger. The point is to own it when it matters. That is why, for me, a position has to start at around 3% to count. If it wasn't at least 3% when I opened it, I don't even want to call it a real multi-bagger for the portfolio because it didn't really move the needle. At the same time, I don't want 30 tiny positions. That's why there are not 500 high conviction ideas in the market, right? So your portfolio shouldn't look like an ETF. For me, around 10 position or less is good. So 10 position is the maximum. Not because concentration is cool, because if I own a company, I want to know it deeply. I want to understand the thesis, the mode, the valuation, and the risk well enough to hold through volatility. Some bets will fail, that is part of the game, but the survivors needs to compound enough to pay for the mistakes. My process is simple. Find companies with durable learning loops, screen them qualitatively, verify them with quantitative data and external evidence, value them with my 4D framework, then allocate with enough size to matter. So guys, I'm looking for trades, not looking for chart setups. I'm looking for businesses where while I wait, compounders compound, moats widen, and winners win. That is what I want to own. So guys, if you want to know more, subscribe to the channel. This is not financial advice.